Corporate Finance presentation, Investment Impact on Portfolio. Get ready, it's time to take your chance with Corporate Finance. Investment Impact on Portfolio. We've been thinking here about longer term type of investments, capital project type of investments, those that typically are characterized as having an outflow upfront that will be resulting in hopefully future inflows multiple years into the future. Although these are longer term type of decisions oftentimes than some shorter type of investment decisions, we do have similar characteristics to normal investment decisions you may hear about with personal type of investments, investing for your personal savings, stocks, bonds, and so on, as well as shorter term type of investments for the business side of things as well. The things that you typically would hear were things like diversify your portfolio so that you can mitigate the risk. Those things apply to the longer term type of investments as well. It's just that, of course, when we think about the longer term type of investments, we also have to take into consideration the added risk involved in the fact that we can't just flip and change our decision quite as easily with a shorter term type of investment. So whether you're thinking about investments or like managerial type of decisions in general, whenever you're looking at the short term things that you can change, then you have that component where you can do the tinkering type of thing. You can test things out if there's not a lot of consequence to the decision that you're making at that point in time, but multiple decisions will have consequence. You can test things out and try things and see what happens. Longer term type of decisions, of course, you can't, just stop the project that you just went into that was a 10-year project quite as easily. You might be able to if you decide that it's no longer profitable, but that's going to be a much more difficult decision to take into place. However, when you're thinking about the decision in general with regards to your overall type of investment decisions, we want to assess the risk for that individual decision. And then, of course, we also want to take that decision and see how it fits into our overall investment strategy as well. So investments that are highly correlated will not provide diversification against risk. So clearly, just like with a portfolio, the idea is diversification oftentimes because that's going to be lowering the risk. So if something is going to be correlated, then that means if you have, for example, investments where if one goes up, the other one goes up. They're linked together, or the things that are going to cause them to go up are the same things. So if you have, for example, all one kind of stocks in your stock portfolio and they all go up when the economy is in one certain condition, and then they all go down when something else happens, then that's not good. Your stocks are too correlated, and they'll look your stock portfolio then will look really good if all those things that happen to make your entire investment portfolio happen to be good. But if they happen to be bad, then your portfolio will go down quite quickly. And that's why oftentimes you think about stocks and bonds, which are supposed to be somewhat different in their correlation to give you some hedge against basically problems, so that everything's not going the same way. So conversely, investments that are negatively correlated will provide greater risk reduction. So obviously, when you take on the risk reduction with negatively correlated items, then you're not going to you're basically admitting that you don't know exactly what's going to happen in the future, right? If I knew exactly what's going to happen in the future, I can put all my stuff in one area and take full advantage and maximize, everything being correlated the same way towards whatever's going to happen. But we don't know what's going to happen. So we have to basically hedge against risk that could happen in the future. And that's really the art of investment over the long term, is being able to say, hey, look, I really don't know what's going to happen. And I'm going to basically oftentimes, and I'm going to basically set up my portfolio so that I can mitigate my risk. So the negatively correlated correlations will basically help with that, and that's generally the stocks and bonds having some weighting between them. When you're talking about normal investments, when you're talking about long-term capital projects, you have a similar type of thing. If you invest in a lot of long-term capital projects and things turn out the way you think they're going to turn out, you will look like a superstar. But if things do not turn out the way you think they will, you'll look horrible, and it'll be all over. They could, everything will be gone at that point in time. So that's why you want to basically hedge against it generally. And you could see this stuff kind of playing out all the time, where people make big bets, and they can, if someone's winning for a short period of time, it could just be luck, that they had everything in the right spot at one time. But over the long run, yeah, it may not turn out so well because you would think that nobody can predict the future for that long amount of time. So you need the diversification to really play it right. So investments that are uncorrelated provide moderate risk reduction. So if they're not related at all, then they're going to have some moderate risk reduction. They're not linked together. They're not going up for the exact same reasons, or one's not making the other one go up, or conversely, but they're not linked. So that again could give you some moderate level of risk assessment or reduction in risk level for the portfolio in a total. So the extent of correlation among various capital projects and investments. So then you can get into, then trying to calculate exactly what the correlation is, and you can get more technical on, what do we think the correlation is for any particular decision. Values between -1 and 1 could be used for our correlation. Negative correlations possibly being more closer to -0.2, for that would be negative correlation. So negative correlations possibly being closer to like -0.2, and positive correlations around positive 0.3. So risk reduction, combining risky assets with low risk or negatively correlated assets can lower the risk. So that's obviously going to be our objective here. We want to get the risk level to where we think it's a manageable amount of a risk level, balancing out, of course, the risk and the potential reward. So obviously what we're trying to do, the primary objective, we want the highest return possible given the risk level. So we have that qualifier, right? When we think about the highest return, we're thinking about the expected return normally. When we're thinking about a long-term capital project, we want the highest return with the qualifier given the risk level, right? And then we want the lowest risk level given the return level. So we're always doing that balancing act when we're thinking about new capital projects. What's going to be the level of the return that we expect to be happening? And all we can do is calculate kind of that expected return, because that's going to be the probability of what we think is going to be happening in the future, and then tack on to that what we think the risk level will be, and balance out the risk level versus the return, noting that we have to consider the risk level for both the project in and of itself, as well as the project as it fits into our overall portfolio.